BlackRock have reported their earnings this morning. We are going to take a look at that in detail. We're also going to take a look at the company to see whether or not it is undervalued, whether we should be buying this company. We're going to take a look at the historical performance. We'll jump into their income statement, top line revenue, as well as their bottom line growth. We'll have a quick look at the health of the company, total cash versus total debt, as well as comparing them to other companies in a similar industry. Don't forget, we will jump into their dividend safety, looking at some very important financial metrics. We'll take a look at insider selling, which has been a regular theme at BlackRock. We'll see what the institutions are doing, if they are buying or selling. And as always, we will run them through our valuation model, getting to the intrinsic value and the acceptable buy price, given our investor margin of safety, as well as taking a look and seeing what are Wall Street expecting for this company over the next 12 months. So let's jump straight in now to their earnings. Now the headline reads that BlackRock are looking or have in fact acquired GIP, Global Infrastructure Partners, for $3 billion in cash and 12 million shares. So let's take a look at that. And also one of the key headlines is BlackRock's AUM, assets under management, has exceeded 10 trillion at the year end, as well as a dividend increase of 2%, which we will analyze later on the channel. So let's take a look now. They said on Friday they have entered into an agreement to essentially acquire GIP, which is an independent infrastructure fund manager, for around $3 billion. They do believe it's currently valued at around $1 trillion today, and it is expected to be one of the fastest growing ones in the years ahead. So it does look like a very positive acquisition for BlackRock, and they are essentially believing this will be a long-term structural trend of support and acceleration in the infrastructure investment industry. So let's take a very quick look at this essential acquisition. So the company was founded in 2006, has more than 100 billion in AUM, as we can see here, and it has around 400 employees and more than 40 portfolio companies that generate a whopping 75 billion in revenue and employ a significant number of people around the world. So it could be a very positive acquisition for BlackRock based on the information we have, and it is expected to moderately boost their earnings per share as well as their operating margin in the first full year after the close. So let's take a look at some other details. Fourth quarter earnings, so earnings per share is up $9.15, $8.29 just a year ago, and also above the $8.87 which analysts had predicted. And we can see their revenue is up 4.63 billion from 4.337 billion last year, and slightly higher, or in fact slightly lower than the 4.652 that were expecting by the analysts. So they beat on the earnings per share and came slightly lower than analyst expectations on the top line. And one important thing to note is assets under management at 10 trillion is up from 8.6 trillion a year ago, and it's only the second time in the company's history that it's topped that 10 trillion mark. Finally, for those dividend lovers, they have increased the dividend by 2% to $5.10, which we will analyze shortly. So let's take a look now. Over the last year, they are up around 5%. We can see on the 52-week range, they are towards the upper end. And in terms of the yield, currently sits at 2.52% with a forward PE of 21. Now, it is worth noting the market isn't open yet, and we can see it down around 1.5%. So it will be interesting on our analysis whether or not this is an undervalued company or whether we are looking to buy a very strong company at a fair price. Now, if you've been holding BlackRock over the last 10 years, you would be up around 150%. Although bear in mind, it doesn't include those dividends reinvested. And the second thing, the all-time high at the back end of 2021 at around just under $1,000 per share. So income statement, let's take a look. 3 to 7% on the top line is what we aim for. 14.2 billion in 2018, 17.9 billion in 2022, and we can see here based on the trailing 12 months 17.6. So over the last 5 years, if we look at the data, we can see yes, it has increased. But if you do note up to 2021 where it had consistent increases, it did fall into 2022. Although based on the report that we just read, they are expecting their top line to have increased from the prior year, which is a positive sign. Bottom line net income then also an increase, 4.3 billion to 5.2 billion, so that is positive to see, but a very similar trend to the top line. It went up to 2021 before dropping in 2022. So overall, the top line and bottom line, they are moving in the right direction. It is positive to see, but there are some inconsistencies. And it is positive to note, based on those earnings that we ran through, that the company is still moving in the right direction. So balance sheet, total cash versus total debt, well, 6.3 billion in 2018, 7 billion from the latest quarterly report. So they are holding on to a bit more cash than they did 5 years ago, but bear in mind they are expecting to pay around 3 billion in cash for that acquisition that we just discussed. Now, total debt numerically, directionally, which way has it gone? Let's take a look. 5 billion in 2018, nearly double in fact in their latest report to 10 billion. So they are holding twice as much debt than they did just 5 years ago, and something we can consider when we look at those financial metrics. So how has the company performed? As we can see very briefly, companies in the asset management and financial custody banks, Blackstone, KKR, Brookfield, as well as a few others. We can see BlackRock over the last year, including those dividends reinvested, is the worst performing, only up 8%. And if we maximize that to the last 5 years, we see it as one of the middle performing, up 127%. So it isn't one of the best performing industry, it isn't one of the worst, but as always, this information is just there to add to one level. As we always say, past performance is not an indicator of future performance. So let's take a very quick look at insider selling. Now, insider ownership sits at around 1%, and we can see over the last 12 months around 57 million of insider selling. Now, when we look at the detail of this, we can in fact see the majority did come from Lawrence or Larry Fink, the CEO. 6th of November, he did sell around 15,500 shares totaling $10 million. So something to note, but again, it doesn't necessarily mean this is a bearish signal. Now, when we look at the same but institutional ownership, we see around 77%, around 37 billion of outflows by these institutions over the last 12 months, and just over double over the same period. So institutions are favouring this company, they are buying more than they are selling, and the largest buy did come in Q2 of 2023. And as we always say, remember not to copy anyone other than yourself and to do your own due diligence. Dividend safety then, 98, it is very safe. Market cap, 118 billion, a mega cap company. Let's dive into some recessionary metrics for those that see a recession inbound. Well, they maintained the dividend during the last recession of 07-09. Average growth, and we see they've near enough a recession return, negative 50% versus the S&P's negative 55. Dividend growth then, well, 2.5% last year, and we just had a 2% this month, or in fact today. Mediocre in my opinion. It is below essentially the 4% we advocate on the channel to keep up in line with inflation. Over the last 5 years, 14% double digits, very positive. Over the last 10 years, 13% double digit, very positive. But the last few years have been fairly mediocre, and they've been increasing those dividends for the last 13 years. So let's take a look at dividend yield theory. So we can see the current yield versus the 5-year average. So dividend yield theory states a company is undervalued when that current yield sits above the 5-year average. So right now we have a sign of reasonable valuation. Forward PE 21 versus 19. Again, we could argue reasonable valuation / possible overvaluation. But as always, we don't look at any of these models in isolation, and we'll draw conclusions towards the end. BlackRock then 21 versus the financial sector PE of 11 sits significantly higher. Free cash flow then, earnings, remember, susceptible to manipulation. We just ignore that. We focus on the free cash flow. Now, below 50% is what we say for asset managers, although you can bring that up to 60%. 2023, it is expected to be 80% there or thereabouts, so probably why we are seeing those mediocre increases of 2% below inflation. 2024 expected to come lower, so that gives me hope that next year we will see a much better dividend increase. Free cash flow per share, $21 to $30. It is increasing, but again, do note the inconsistencies. As we can see here, it has decreased, but also increased year on year. Sales growth then, 3 to 7% for steady moderate growth. Double digits is ideal, but again, do note 2022 negative 8%. So every year hasn't been positive, just something to bear in mind. It does fluctuate. But numerically speaking, an 80% increase over the period from 10 to 18 billion. And they also do share buybacks, maybe not as much as you would like. They do return excess cash to investor pockets, but 174 million to 152 as we can see. ROIC then, 10% or more, remember, is what I personally look for. Gives me faith management are able to effectively allocate their capital. And we can see here, they do bring it up for asset managers to 25%. But personally, I am happy with around 12 to 15% as we've seen over the last few years. Operating margin and free cash flow margin very positive. Operating margin quite high, above that minimum 25%. Free cash flow margin at around that 20% boundary that we set for these companies. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, remember, shows us the balance sheet strength as well as dividend safety. 2022, 0.15 years to pay off all of their debt net of cash on hand. 2023, 0.38, still well below that 1.5. So we can see why essentially this company's dividend is safe and has a strong balance sheet. Let's jump into the valuation. As always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the valuation model. Now, typically for Graham's valuation, which is the first model, it isn't one that we do use for the asset managers, so we will jump straight into the multiples valuation. We have companies in a similar sector and size that we analyze on the 5-year total return. We have their P multiples and the average PE. We get to the intrinsic value, which comes to $440, significantly lower than the market value. So we have a sign of overvaluation, but bear in mind we're not looking at any of these models in isolation and drawing our conclusions towards the end. We then have the dividend discount model, very nice average growth of around 10%. Forward-looking growth rate, we've gone for 6%. Now, they did decrease this to around 2% this year, but this is looking for the future, not just the next year or so. I do believe they will start to increase it much higher, especially as we saw that free cash flow payout expecting to come down considerably lower. Intrinsic value of just over 1,000, then showing us an undervaluation signal. And then for the DCF, we have the free cash flow year on year, growth rate per analyst expected estimates with that discount rate, the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to get an intrinsic value of $944. Again, another sign of undervaluation. So the intrinsic value here is just the average of these three models that we've used for BlackRock today, coming at $814. So the current price is $788, although as we have seen, this price is fluctuating as it is in the pre-market, but it is currently down. So let's look at the margin of safety. As always, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see right now it doesn't currently have a margin of safety of 10%. If we look at 5%, it isn't too far off still. It isn't the most margin of safety company we have analyzed on the channel. But again, this is a company that has just had the earnings reported. It is in the pre-market, so when the market opens, this company could go down. It is one that I would like to add to my portfolio, but a much higher margin of safety, maybe around 20%, which is a buy at around $650. As we can see, that is still within that 52-week range. Now, in terms of Wall Street, what do they believe? Well, they see the share price going up to $877, so they see around 11% upside. As always, though, let me know your thoughts with BlackRock. Is this one that maybe you own? Are you happy with that dividend increase of 2%? Are you happy with their acquisition? Or if you're an investor on the sidelines, is this one you are looking to add at a recent price that we have seen, or are you waiting for a larger drop? As always, catch you on the next episode. Don't forget you can click on the pinned comment below to grab a copy of the valuation model, getting to the intrinsic value and acceptable buy price of companies, whether it's your own portfolio or on the watch list. Catch you on the next one.